Hello, I'm Lucinda Joseph. You're watching the Star Online TV's forum on investing at the point of maximum pessimism. And in the studio with us today is Mr. Lim Chee, a head of research from RHB Research Institute, and Mr. Justin Tan, market strategist from ChartNexus research team as well. Gentlemen, welcome to Menara Star.
Hi.
Okay, let's just start off with on the global front.
Sure.
Okay,
Yeah.
the economy. There's been lots of talk about the global meltdown, a lot of gloom and doom. So can you can you set the stage and paint us what the actual picture is like?
Yeah, if you look at the global situation, obviously the credit crisis is still deepening. Look at the contractions in the major world economies. They are actually very, very sharp. U.S. economy contracted by 3.8% on an annualized basis in the fourth quarter. You look at the Euroland contracted by 5.9%. That's the worst in at least 13 years. Big economies within Euroland, Germany, France have all contracted severely. The contraction was worse in more than 20 years. Japanese situation is not any better, contracted by 12.7% on an annualized basis. In the fourth quarter of last year, that was actually the worst in 35 years. And yet there is no solution to the current banking impasse in the US and European countries. So they have actually cut interest rate to the floor, that implemented bailout and stimulus packages, and yet the banks are still reluctant to lend because of risk aversion. And as a result, which there is no liquidity flowing down into the economy. The private sector is still starved for capital. So obviously, you see more contraction in the global economy, leading to fear that you may see a meltdown to a situation like the Great Depression that started from 1929, persisted to 1932, lasted for 44 months.
So are we looking at a similar situation now?
I guess if you look at it, during the Great Depression time, what happened? I mean, the causes are the same in the sense that it is actually the bursting of an asset bubble that went into a liquidity and credit crunch. But in the Great Depression situation, the developed country did not bail out the banks and the corporate until a much later stage. But still, they tightened policy, raised interest rates significantly to actually preserve the gold standard. As a result of which there was a massive liquidity and credit crunch. Now the difference is that they've been very aggressive, infusing massive amount of liquidity into the system. They do bail out and implemented stimulus packages. At that time, developed countries also implemented very strict protectionist policy to protect the domestic industries. As a result, import into the developed country contracted significantly. That's why economic output contracted by double-digit rate in the developed countries like the US. Unemployment rate surged to 25%. Now the situation is bad, but I think it's not as bad. Policy responses are very, very different. So we think we will not get into a Great Depression, but this recession is actually the worst since World War II.
Okay. What about the local market?
Well, maybe think about the local situation first in terms of the economy. Now, you look at it, we cannot be spared, obviously, because it's a very open economy where exports account for about 125% of GDP. When export starts to contract, it has already contracted by 14.9% measured on year-on-year basis in December, leading to foreign industrial production. Industrial production contracted massively by 15.6% in December. That's actually the worst contraction, even worse than during the crisis situation. During the crisis situation in the region, the low point was in November 1998, and industrial production contracted only by 12.3%. So if you look at it, when exports are contracting badly, industrial capacity utilization falls. You have a lot of excess capacity. Businesses will postpone, delay, or even cancel investment. So private investments is already contracting, I believe. As a result of which, the external shock to the economy is actually very, very severe. Now you have to counter the external shock with domestic demand. Domestic demand, you're looking at private sector demand as well as public sector demand. Now in terms of private sector demand, investment is already contracting. It depends on consumer spending. Yes, it's account for 50% of GDP, but looking at the current situation with massive retrenchment coming up, already manufacturers have retrenched 68,656 workers over the last 8 consecutive months up to December last year, and that's just the manufacturing sector. Obviously here, I'm defining it to include workers, not just permanent workers, contract workers, foreign labor as well. So consumer confidence has actually plunged, as a result of which consumer spending is actually slowing down rapidly as well. There is a need for government to come out and implement stimulus packages, easing policy to cushion the downturn, to prevent the economy falling into a recession. But unfortunately, it's constrained by budget deficit, it's constrained by slow implementation process. Let's say you look at the first stimulus package of 7 billion ringgit, only a fraction has actually been filtered down to the ground, even though ministers have come out to say that about 5 billion has actually been dispersed to the various ministries, but they've not gone to the ground, so haven't been felt to instill the confidence. So economy, I think, will definitely fall into a technical recession as well for Malaysia by the second quarter.
Mm-hmm. What are some of the measures the banks have taken? Will that help cushion the effect?
It will actually cushion the impact, but it will not prevent the economy from falling into a recession. I think it's actually a bit late now when the economy has started to contract. What it will help is to cushion. And when economic recovery process starts to be on train, it will help the process of recovery.
Okay.
That's what we're looking at.
Okay. Mr. Justin, could you give us some analysis of how the market outlook has been based on the charts that you have?
Okay. Probably we look at the global fund. And I think one of the benchmark most people will still look at is based on Dow Jones Industrial Average. And there's actually a very critical level on Dow Jones currently right now is at a level of 7,555. Okay, if you look at the chart currently, it's trying to find its support level previously. It tested once sometime in November 2008. But basing on yesterday's performance from Dow, there was an additional 89 points closing lower. And that itself actually closed back at 7,400. About there, which means Dow Jones actually already breached its critical level. Now, what I meant by this 7,555 level as a critical level is because from the chart itself, if you look back to the historical, back towards in year 2003, it was actually its previous low. So if it breached this 2003 low, which is 6 years, you're looking at a 6 years period of time. When this kind of sentiment kicks in, pessimism will be maximum, and I think we are looking at further downside. But again, if we are looking at this for the past 1 quarter, since October last year to January right now, Asia region, if you look back at Asia region, Hang Seng and even Singapore STI actually has a what we call a relief rally, a short relief rally.
How long did that last?
I think it's still there, but personally, would it still last? So from the side, if we are looking at US market, if it breached through 7,555, I'm quite confident that the relief rally wouldn't last for in a short period of time anymore. And in fact, if we look back into KLCI benchmark, for the past since the relief rally started in October up to now, we actually have about 17% recovery from KLCI benchmark itself. But you look at the whole front of the global economy, even if you refer Hang Seng and even STI, each and every one of them are reaching a critical support level, which to me, it actually reflects a very unhealthy recovery right now in KLCI, which means it might not last actually. It might not last for very long. In fact, if I'm looking at a short-term wise, we can safely say that there might be further downside.
Okay. We're talking to Mr. Lim Chee Sing, Head of Research from RHB, and Mr. Justin Tan from ChartNexus, and who's going to give us some optimism during this difficult times. But first on, let's talk to Mr. Lim about the market outlook. What are the fundamentals?
Justin talked about the market outlook from a technical perspective just now. But from the fundamental view, I think the market is also going for a downshift. Simply because you look at a relief rally, to me, it has actually happened from October 28 last year up to January 7. The CI benchmark has actually moved up by about 17%. As it stands, data releases coming out from the developed country as well as for countries and region are beginning to turn out to be very, very negative, more negative than what the market has actually discounted. Okay, and you look at it, there is another risk that the global economy is going through. More and more countries are beginning to fall into a deflationary situation. Deflation means falling, not just falling general goods services, as well as falling asset prices on a more sustained basis. Thailand has already fallen into a deflation. You look at Japan, you look at the Euroland, you look at US, they are all moving in the same direction. In deflationary situation, there will be postponements in terms of purchases that would create fear of a more protracted downturn in the global economy. When this situation starts to appear more and more in the global arena, it will create fear of more protracted downturn. It's enough for the market to go for a downshift after a relief rally has already happened. So this downshift could actually be quite significant in my view to cause the market to actually react. Okay, but if you then look at it, just like every crisis, it's actually a danger for investors, for companies or business people that are relatively geared up, having cash flow problem. But for companies, businesses, or even for investors who are relatively liquid, has got cash flow and balance sheet, you should look at it as an opportunity. Buy low and sell high. When you start to look at risk-reward situation, when reward starts to outweigh risk, if you can take a longer term view, you should actually focus on the market as a situation to buy or witness when there is significant sell down in the market.
So what are the options that people have in investing? Which key sectors would you recommend?
If you look at it, a lot depend on investors' risk-reward profile and their own preferences as well. Now, if you look at it, the equity market is actually the most liquid market relative to property, relative to other form of investment, like gold, for example. Some will go into bonds, but for individuals, you need the bigger amount to go into bonds other than investing in bond funds, when you have to pay quite substantial upfront costs. The equity market is still the most liquid and the easier to get in and to get out, since they have actually fallen so significantly and will fall more, likely to fall more in the process. You should actually look at it to buy and witness, and that will give you the opportunity to make substantial return. You can take a longer term view because cycles never fail you. See, what goes down must come out. Question is length of the down cycle. This down cycle may be longer, but eventually it will come out as well. And in between, when the risk reward has actually shifted to reward, question is, when to get in and what to buy in this sort of market. You had to focus back on fundamental and buy on witness for longer term returns.
What sectors would you consider very resilient during times like this?
If we look at it in terms of resiliency, there are actually not many sectors. In fact, no sectors will, no sector is actually totally resilient to the downturn because demand will drop. But you look at sectors which are more defensive, like for example the power sector. You can look at telco sector where cash flows are very, very strong, or even the gaming sector, those concession holders like Plus, Lightrack, or even the food and beverages, the healthcare sector, when demand will remain resilient. But I still don't suggest investors get into the defensive sectors and stocks because in an impending downturn, I would say you go defensive. if you have to be in equities. But if you can go on cash, you will go on cash because what can go wrong will go wrong. But once the downturn has happened, question is timing of recovery. You will actually look at fundamental stock that are liquid enough, has actually been battered down, so that when investors start to position for recovery, the capital gains will be the biggest. In fact, you look at most of the funds, they have defensive stocks in their portfolio. If you start to turn more positive, will you add more defensive stocks to your portfolio? Chances are you would. But when you start to turn more optimistic and start to position for recovery, you will start to switch out of the defensive stock and buy liquid fundamental stock that has fallen significantly, because by that time, defensive stock would deem to be very expensive, right? And the potential upside is not only not there, it will fall when investors start to switch up and to go for recovery stocks.
What about investing overseas? Is that a good idea?
Well, investing overseas, I think, is for the more sophisticated investors, be it individuals or institutions. Generally because you have to take foreign exchange risk in the first place. Secondly, you have to be familiar with the foreign market because of the volatility. Let's say you look at Korean market, Taiwanese market, Hong Kong market, they're actually very volatile. Okay, if you don't know the fundamentals of those markets and try to invest, chances are you buy stocks at the wrong time. You may suffer more significant losses. And if the currency starts to depreciate against the ringgit, you have currency loss, then you have a double situation to actually fear about as well. So I think you have to familiar with foreign market and comfortable in taking the foreign exchange risk before you can invest comfortably in the foreign markets.
Now, what happened is that, just to follow up from what Chee just mentioned, I mean, against other investment vehicle, for example, property or gold, I think equity market is still something to look forward to. The reason is that from October to January, during the relief rally, a 70% recovery, actually a lot of people can actually maximize from here.
Let's talk a little bit about the upcoming National Investors Symposium. Maybe Mr. Justin, you could highlight to us what...
We focus on two areas. One area from our keynote speaker, we have invited Chee, okay, to come on board to share on the funding view as well. Okay? And the second portion is where we zoom into the technical analysis portion. That's where we time the market. So from various sector towards the various stocks itself, we time how to time into the market itself and what stock to look for.
Okay, thank you very much. With that note, we'll end this session. I'm Lucinda Joseph. Thank you for watching.